Welcome to the Vondelson Podcast. Today we're covering another Winners and Warning series with Deputy CIO Adam Rich. Welcome, Adam.
Hey, Dan.
So, Adam, today we're going to touch on AI again. This one's titled the missing half of the AI debate. We're still fairly early on in the Winners and Warning series, but this is the second time that you've elected to focus on AI. Quick question here. Why are we revisiting the topic so quickly? Is AI that substantive in your work when you're evaluating businesses?
Yeah, with the capital allocation framework, we track the way companies are allocating capital. And what's interesting right now is we are seeing some pretty significant changes in the way technology firms are allocating capital, not just the infrastructure layer, but the deployment layer of AI. We were thinking about this topic as something we would do later in 2026 or 2027, but because things have become so dynamic already in the first quarter, of 2026, we thought we'd bring it forward.
So thinking about just an intro for this podcast, a lot of what we're seeing with the AI debate, it focuses on automation, right? And history suggests that that's really only the beginning. When we see constraints collapse, infrastructure is built out, durable wealth that's created when we see companies that begin to reorganize around it. So, in exploring that pattern, let's talk about defining first and second order innovation. So, Adam, when you're looking at these, how do you consider the difference between the first and the second order innovations?
Yeah, the way I would describe it is that first order innovation is very, very dramatic, uh, and and the big reason for that are the numbers are always staggering. Think about building out the railroad. Think about electrifying the country. Think about building out the internet, right? All very dramatic. And they all are financed typically with debt, and they all end up in a bubble and with a dramatic end. Uh, AI build out right now is going to be very similar. Right? It's debatable where we're at on the infrastructure layer, but that is first order innovation. It's when we have some innovation that drops the cost of something, whether it's transportation, electricity, or distribution, all those different things. That's first order effects. The second order innovation is things that come after, and that's typically a company who's reorganizing around the cheaper cost to be able to deploy a system that could never have been dreamed of before. And when you go back in history, usually the value created, this second order innovation, typically is 5, 10x whatever the cost of the first order innovation was.
All right, so you touch on a couple of different examples: railroads, electrification, the internet. Want to run through those a little bit. So, railroads, right? Those are massively capital intensive. They were heavily financed with debt. They ultimately triggered a lot of financial instability. And then, your argument here is that the real story really isn't about speculation. Is the collapse of the cost of distance. And so now thinking about how do you separate the short-term financial excess from those long-term structural changes?
Yeah, if you go back and read the New York Times during these time periods, which I love doing, I love reading the front page in the New York Times and other time periods. What you would see during that time frame is, for railroads in particular, safety was a really big theme, like the safety of it. And interesting, right now, safe AI safety is a big topic too, right? And you go back through all the different big infrastructure build outs, safety was always a big topic. And so, yes, it always does. And because of the way that these infrastructure things are built out, it's because of the debt financing that it does trigger bankruptcies. There were some pretty famous investment banks that blew up. Um, Back in the late 1800s, because of the railroads. And so when you think through, this drop of transportation costs, what was really important at that time was your business needed to reorganize around it. And by doing so, you're able to do something you couldn't do before, which was build a national brand, right? How many national brands were there before railroads? There weren't many, right? But then afterwards, we had some pretty big ones.
Yeah. And so if the most durable wealth it wasn't created by the railroad operators themselves, but more so by firms that reorganize around that idea of what you just described, right, with national scale. What does that tell us about where investors should look during an infrastructure boom?
Yeah, so this is what's really interesting about that time frame, right? Like at that moment, everything was just so localized, right? Farmers were only selling to their local community, but now you could sell across the country. Same thing with commodities, other commodities you can move, right? And then there were companies like Montgomery Ward and Sears who built whole new distribution systems, decades after, based on the railroad system, to be able to build national distributions, and that gave them a bunch of competitive advantages for them to take to really generate a lot of wealth. But right now, right, you have to really focus on which companies are really reorganizing their business around AI, and not everyone is doing it, even though they like to talk about AI.
All right, so electrification, right? Another topic you mentioned here. So with electrification, productivity gains, they also didn't show up immediately. There was in fact a fairly long lag. It was called the productivity paradox. Why did it take so long for the economic benefits to materialize with electrification?
You know, AI has a lot of similarities to electrification, but what was interesting during that time, everyone thought that there would be a huge productivity boom because of the reliability of electricity. But what ended up happening, and just to give an example, all right, there were factories that were built on steam power, right? And what happened was you would have at the center of your factory your big steam generator, and then you'd have a bunch of mechanical things that were built on top of that. So if your steam engine went down, the whole system stopped. And so what they did was they went in and they replaced all those steam engines with, with power generators, but they didn't change the format of the factory. And so there wasn't a massive productivity gain. While there might have been some, there wasn't a massive. It wasn't until, the best example of this, Ford, came in years later.
So, would it be fair to say at this point, the real breakthroughs that they didn't come from installing electric motors for Ford, but from the redesigning of the factories around the distributed power, right? And if that's the case, what does that imply about how we should evaluate early adoption of new technologies?
Yes, this is really important because it was a long time after electrification came that Ford came in and built a distributed factory. And that allowed for massive improvements. I think the numbers for Ford was it would take them 12 hours to build a Model T, but then once they redesigned the system, they were able to do it in 90 minutes. Right. So it was a massive improvement. And why was that? Well, you were able to distribute power around the whole factory, have very different machines operating. If one machine went down, that's okay. Everything could keep going and then you can fix it. It wasn't the whole system was down. And so you had to think about the amount of capital that had to be invested to update all the factories to do that. It just took a long time. And that is very similar to right now, right? Because if the killer app for AI is robotics, which is kind of the thinking right now, a robotic factory is going to be very different than a factory that has humans in it. And so then the question is, and this is what Siemens is talking about right now a lot, is we have to redesign what the factory looks like in AI, because you need to, if you're going to design it, everything with AI and get it to the factory floor, you can really cut down time and speed the market.
All right, and as it pertains to the internet, right? So the internet build out 1990s, it consumed enormous amounts of capital. Very much of that was actually ended up being written down after the dot-com collapse. But here we are today. We see companies that were founded in that era. They represent trillions in market value. How do you reconcile the bubble narrative with the scale of second order valuation creation that followed?
Yeah, this is really important. Infrastructure is not where the value is created. And it's all the companies who reorganize around the new infrastructure and the benefits that that infrastructure provides. That's where the value is created. Look, estimates back in the 90s for the build out of the internet was around $1 trillion. Right? If you go around and just add up all the companies who started between 1995 and 2005, what you'll find is most of, like, that value is close to 9-10 trillion dollars right now when you also include all the Chinese internet companies too. So 1 trillion for 9 trillion, right? Like, most people would take that trade off right now. Obviously, it took decades to get there. That's not something that happens in years 1 and 2. And when you go back and look at the internet, again, talking about the productivity paradox, the first half of the 90s, people were really concerned that the internet wasn't going to provide the productivity it did, but then it showed up in the late 90s. And so it does take time for productivity to come back, which is, we're talking about this now, and the productivity for AI probably doesn't hit until late 27, maybe 28.
So do you think it's possible that what looked like excess at the infrastructure layer was ended up being actually the necessary precondition for platforms to reorganize their entire industries, and that just markets they simply mistimed what we were looking at for a payoff.
Exactly. That's exactly what's happening right now. Everyone's really excited about the infrastructure build out, the benefits of it, the companies who are going to benefit from it, but we will overbuild it, right? We will overbuild it. And there will be companies who financed it with debt who will see their value collapse to zero, and then the industry will consolidate. But we'll improve the supply, and we'll keep investing in the infrastructure. Right, the internet infrastructure is still being invested in today. The AI infrastructure will still be invested in 10 years from now, 20 years from now. But there's just always this excess at the very beginning because of the excitement behind it.
All right, let's apply this to AI. So today, AI it seems to be in that that what I was describing is really phase one, first phase, massive infrastructure build out, huge investment and concerns about overbuild, public narrative that's focused on automation. I mean, these are all the themes that we just talked through, right? So what gives you the confidence that the more important story really lies again in the second phase?
Yeah, I think when you think about uh, what it really enables, it is that the cost of experimentation is dropping 90%. So it's a massive drop in experimenting. You can run as many experiments at very, very cheap costs. And so that has a lot of benefits for a ton of industries. Obviously, the one that's most talked about is drug development. But even with software, you can test new softwares faster than you could ever before. And you go down the list, and there's so many different things because the cost of experimentation has dropped. Right now, what we see in the headlines is, well, that's going to impact X amount of jobs, and we're going to lose 20-30% of the jobs because of this. What it doesn't capture, what all the headlines don't capture, is, okay, well, when you drop the cost of innovation that much, how much more products can you develop? All this new product that can come because of AI, and how much GDP is attached to that, and what jobs are created attached to that, is not being discussed. And the reason, it is impossible to model, right? Because it's such a big step function lower. But there are companies who are talking about it. We can real quickly with L'Oreal. They came out, they're at CAGNY last week, talking about in late 2024, they decided to really reorganize around AI. And what was great about it is they said that they could develop products faster. And so right now they're seeing 150 basis points improvements in new products because of AI. Right? That doesn't seem like much. Well, and that's because we're just in year one. But now, years 2 and 3, what we're going to see are faster products going to market, being developed, be targeted correctly, and higher returns for L'Oreal, all because of reorganizing around AI. So we're still early in the benefits of it, but yeah, we're starting to see the organizations who can really, that drop in cost of experimentation drives faster revenue.
Okay. So I really like what you're saying there. The whole concept of AI reducing the cost of experimentation. Um, what are some of the concrete capital allocation signals that you look for when you're determining whether a company is truly reorganizing around that constraint, or alternatively they're just simply layering AI into some of their legacy processes?
Yeah, this is really really key, because you can pick up on this from the way a company is allocating capital. We believe capital allocation drives everything. And so the key here is understanding, okay, well, how much productivity comes from AI? If you're a software business and you can get 30% more productive, what are you doing with that productivity? Are you cutting costs, or cutting costs, or are you launching more product? And so you can pick up on that with the way the companies are allocating capital pretty quickly. And then on top of that, right, it's really important to note that in year one of deploying a new technology for companies, you tend to duplicate costs. And so you have to be aware of that duplicate cost, because you're probably going to be running the cost of AI on top of what you've already had before. And so what's interesting about that is, you can go back and now identify the companies who were deploying AI sooner rather than the others because of that duplicate cost analysis. And you can pinpoint who's doing it and who's not.
All right, so let's wrap this thing up today. Thinking about history as a guide, right? I think we've gone through some really terrific examples, but infrastructure waves, right? Those created a lot of volatility in the first phase, brought in durable leadership in the second phase. So here we are, we're sitting still very much in the early innings of AI. The real investment question is less today about who is automating the fastest, but I would say it's more about who is quietly rebuilding their entire system around a new constraint. Was that fair?
Yeah, that's a great way to put it, because right now, right, if you are coming to market and saying, "Oh, we're investing in AI, our costs are going up," there are dozens of companies who did that back in 2024. I remember the team meeting that we had at Von Nelson. We're all sitting around the table like we do every week, and we were talking about the productivity that came in software development back in 2024. And we all said the same thing: either you're going to cut your costs 30%, or you're going to produce product. And either way, that makes software really hard to invest in, right? And that's exactly where we're at now. And what's interesting right now is you've got companies who are cutting costs and getting productivity now in software, all because they made the shift 12, 18 months ago. And then there's a bunch of software companies who haven't done anything. They're not shipping more, they haven't cut costs. And that's a big problem. Those are the value traps, because those are the companies who are just too far behind to really win. And so I think right now you really have to sit down and think about, has the company truly reorganized around AI, or are they just adding features here or there?
All right, good. That's a good place to stop for today. So thank you. Thanks for coming on. Certainly enjoy this winter's warnings, and look forward to hearing about the next one.
Thanks for having me, Dan.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Von Nelson and its employees. Von Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Von Nelson or used by Von Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Von Nelson strategies.